Hey guys, John Paulamy here, Actionable Intelligence. Today's interview, I have a pretty interesting fella on here, Benjamin Damasi he's the Royalty King on Substack. And I've been following his work for a while. I've talked to him in the past. He's had me on he's interviewed me once. He wrote an article recently that I found very interesting. And so I wanted to talk with him because I think you'll find that he's an interesting uh, guy and his approach to investing and creating income is kind of unique. So, welcome aboard, Benjamin.
Oh, thank you so much. Appreciate you having me on.
And you're calling in from down under, I suspect.
Yes, I am. I just got back from a little trip to Florida and the US, just down the road, mate. No, it took me it's basically a 24-hour journey for me to get to the east coast of the US. But I'm no stranger. I've done it before. Had a great time at the Rural Symposium and spent some time in the Bahamas. So no, pleased to be back here and even more pleased to be with you talking shop.
Cool. Why don't you, because I think a lot of my viewers and subscribers aren't familiar with you. Can you give us a little, whatever you feel, you want to talk about your background and what you're doing and what your philosophy is, a little bit around investing.
Sure. I promise I'll be quick. I don't want to bore too many people, but basically, I grew up here in Australia. I spent nearly a year, 6 months in Italy on exchange when I was a kid. So always, I remember since the second grade when I was looking, all the other kids were reading comics and that sort of thing, and I had an atlas open. So I had a very, I guess you'd say, a broad world view, and I was fascinated with the connections between this place and that place. And so I always had a mind for travel and for a global appreciation. And I studied health science, sports medicine, and physiotherapy. And as soon I hated the last 2 to 3 years of structured education. I just couldn't wait to get out and get into entrepreneurship. So during my university days, I did all sorts of weird and wacky side businesses and hustles, typical scrappy entrepreneur. And then I went in and founded my own business and did some private business investing, rolling them up, which came to fruition. I sold those on April 21st, 2020, which was an interesting time for many people around the world, particularly if you were here in Victoria, Australia. And from there, just started to figure out what I was going to do. So at the time, we had the lockdowns and we had all sorts of really, really bizarre, I call them social experiments that were not particularly to my tastes. And so I decided to use the time to figure out whenever they did open the borders in Australia, because remember, I really couldn't leave. They'd locked down the borders. And I figured, okay, once they open up, I need to be ready. So they eventually did. And then I decided to plant some flags around the world. So I said to myself, I want a place in Europe, I want a base in the Americas, and obviously I've got my base in Oceania, in Australia. And so I then decided to remove some of my ties to Australia that were really heavy. So a real estate portfolio is a bit difficult to take with you in an emergency. So I sold that down. I started to get residencies around the world and citizenships around the world. And from there, I said, okay, the missing piece of the puzzle is income generation. How am I going to generate income that doesn't necessarily require my physical presence in any particular location? And so that gave birth to me looking for digital sources of income was really the most logical solution. The problem I had was I had just come out of owning, running, and managing a business with employees and dealing with the overheads and all the administration that one has to navigate as a business owner. And I said, gee, wouldn't it be great if I could really cut that down? And so that's where I decided not to go down the e-commerce path, not to go down necessarily the consulting path, although I have ended up back down the consulting path. And I looked at options as a way that I could run essentially a one-man insurance company.
Interesting. It sounds familiar. I'm a big fan for about 40 years of Doug Casey, which I know you know who Doug Casey is, the international man, the original one. And I think he said one time, bank in one country, have your business in another country, and live in a third country. And that way you kind of get the best of all worlds. You're not a milk cow tied down to one state and all that. So I won't go too far down that road. That's kind of a whole nother interesting topic. But um, what? Why don't you expand a little bit on because I think it's interesting because I think it will take us right where we want to go. The royalty king, and you kind of alluded to it a little bit about options and stuff like that, and that's really what the gist of this article was about. But kind of the whole royalty king philosophy, because I think it's a lot bigger than just options and kind of your philosophy on how this can work.
Certainly. And I think, thank you for asking because it brings up a very important point to clarify. So, on the one hand, I have an income generation strategy, but the biggest piece of the puzzle is my long-term wealth accumulation portfolio. And that is what led me down the rabbit hole of changing from, you would call it a traditional deep value investor, a Ben Graham, Walter Schloss type guy that would buy things at half, three quarters book and wait for a reversion, things trading at a cheap discount to what I thought their cash flows would be. And I don't know if you've had this experience, but that can lead to some great results and it can also lead to some frustration. And when you the issue is, if I look at it from like a decision tree perspective, let's say I perform a great deep value deep dive, I make an investment and I succeed. I've almost now become a victim of my success because if you're doing deep value on things that are particularly cyclical in nature, they tend to be the sectors that give rise to such opportunities in the first place. I now have a capital reallocation problem. So I need to sell, I get taxed, depending on the people's tax situation around the world, that might be quite hefty. And it really might eat into your ability to compound those gains over time. And so in around, I think it was around 2022, 2023, I was in Panama and I had um, been studying a lot of the works of James DeWollis from Horizon Kinetics, who's now a friend of mine, which I'm very privileged to have. And as I was reading through this idea of finding capital light, efficient businesses, it made a hell of a lot of sense to me, particularly when you think about Warren Buffett's journey from being a deep value investor, a cigar butt investor, and then meeting Charlie Munger, who I guess had the same kind of influence on him to say, look, let's take a look at a business that can provide really high return on invested capital sustainably over time. And that's going to equal basically our investment. And that was a game changer for me, particularly when we were in the midst of 2022. We had the oil spike based on the Russia-Ukraine scenario. We had that weird thing where nat gas and coal just went on a march straight upwards. And then, of course, all those things went on a march straight downwards. And I thought to myself, this is interesting. It plays into a lot of what Doomberg likes to talk about gluts, spikes, and then troughs, particularly in the cyclical commodities market. And over time, those commodities all tend towards a lower pricing in real terms. So it was interesting for me to read through quarterly reports from the likes of your Chevrons versus your Texas Pacific, Landco versus your Viper Energies, and looking at how the operating model in a down environment led to operating losses in the producers. Whereas you looked at Texas Pacific, you looked at some of the land holders, the royalty holders, and yeah, in a softer environment, they made less money, but they still made money. And so that seemed to me to be a really good way to ride out the volatility in markets. If your choice is between making lots of money one year and then, okay, a bit less the next year, but you're still positive, that return on businesses that do not require capital expenditure to operate was a real epiphany for me.
Yeah, I'm glad you brought up Horizon Kinetics. I've tried to let folks know that, I mean, they have an extensive library of their writings on their website. They kind of do quarterly, uh, I don't want to say reports, but writings or what have you. and you can go back and look at it. And I think that the management there is very. I've learned a lot. It changed my thinking a little bit. Of course, the Murray Stahl is a big. I'm a big fan of his, and I've got everything just about that he's ever written. I've printed it out and read it. So I encourage people to, especially just his story about how he discovered Texas Pacific land. You could go into that a little bit. Take 5 minutes and just talk about Texas Pacific land because it's actually a unique story, and it's really the kind of like the poster child for what you were just talking about, capital light, compounding over time. But it's almost like it kind of, you know, they kind of fell into it. But I think give us your give us a short 5 minutes on it.
Sure. I need to say firstly that the Royalty King was not a name I gave myself. It was given to me actually by a mutual friend of ours, Steve from the Unemployed Value DGen.
Oh,
He was making fun of me that all I was writing about for a long streak were royalty type businesses, and that's because I thought they were the best value opportunity out there. In any case, to your point around TPL, it's very rare that you come across a situation where uh, a company or a trust in the original case of Texas Pacific it simply inherits land. I mean, it doesn't happen every day. So Texas Pacific was the old failed railroad between Texas and California back, I think it was in the late 1800s. The idea was to bridge Texas and California so you would have a back and forth railroad to move commodities, people, etc. And it didn't work, unfortunately. And so part of the land there was in the bankruptcy was formed into a trust that would hold that land, and that was Texas Pacific Land Trust. And since then, over a little more than a century, you got to imagine out there, Texas at that time, it wasn't particularly valuable. It was just basically pasture grazing for ranchers and not much else. So we have a situation where the trust has simply inherited an enormous amount of land. And something that's particular to Texas is obviously you can separate the surface acres from the mineral estate that lies underneath. And so over time, fast forwarding, Texas Pacific received grazing revenues. They received, basically some rights of way, not too much, and they were able to sell certain parcels of land when it made sense for them to do that, and they could buy back units. Over time, this led to an amazing compounding machine. Imagine someone gives you all this land, you get fees for letting people put their cattle on there, and then when it's convenient, you can sell parcels and you can retire some of the unit holders. I mean, this is just a when you talk about return on invested capital, it's almost infinite because there is no real invested capital. They got the land and then they were just getting fees on top of that, and they were compounding that at like a geometric rate because they could do the buybacks. Then, of course, we get into the 60s and the 70s where there's more development happening. There's more, the economics around oil, thanks to changes in technology, start to change. And so, obviously, you go through this higher and better use for the land, which gives rise to a thesis that land and water, you could argue gold, are really the only commodities that do hold their value and increase in real terms over time. Everything else starts to fall. And in the case of Murray, I believe it was such that when he was starting his career at Bankers Trust, and he learnt about this company, and one day he was in the building for a completely separate purpose and somehow took a wrong turn, ended up at Texas Pacific head office and said, "Oh, sorry, I'm in the wrong place." Went to the other meeting and then couldn't concentrate in his meeting because he was wondering what the guys down the hall were doing. And long story short, Murray is very, very good at sizing up an investment thesis that most other people can't see. And he did that really quickly and said, hang on a minute, there's certainly something to this. This might be the best company that I've ever seen. And honestly, if you look at a price chart from then to now, you got to say it was pretty much spot on. So he began to buy it. He's held it for several decades now. He continues to buy it every day on the open market. And so that's his connection, how I became familiar with TPL. His idea was that the vast amounts of hydrocarbon reserves under there eventually would become economic. And in 2014, 15, um, he was proven correct with the arrival of the shale patch technologies. In terms of Texas Pacific, in short, so I don't make this too long, if you look at the return on equity, if you look on the return on capital, you're getting around about a 40% annualized return for decades. So if you go back and you plot Texas Pacific and then you add Bitcoin on there, Texas Pacific is really the only thing that has kept pace with Bitcoin since its inception. And I've never heard anyone else, to my knowledge, no one else has ever made that connection. I wrote about it in one of my articles, but you can literally plot one over the other and see what that compounded rate of return has done to a little old failed railroad trust that is Texas Pacific. So I liken it when I'm trying to go through the thesis for the first time with people, I liken it to a bank account. And it's a preposterous example, but I'll give it to you anyway. I say, imagine you had a bank account where instead of getting 3% interest, you got 40% every year. And you left your money in there and it continued to compound over time. Well, that's a bank account. It doesn't really require any expenses other than maybe a few admin fees here and there, depending on your bank. Honestly, that's a pretty close analogy to what Texas Pacific is. It does not engage in any of the activities really that occur on its land. It simply collects the fees in exchange for right of way for passage on the surfaces that they own. And of course, they allow hydrocarbon drillers to perform their extraction operations on their lands in exchange for a leasing fee and then a royalty percentage of the production. So hopefully I gave you a fairly concise summary. There's a lot to talk about.
No, that's pretty good synopsis. I mean, you can really go into a deep dive and if you go into further into some folks's some folks have a thesis around data center. We won't go down that road, but there's another company too that is doing something similar, but they bought a bunch of land. They weren't just gifted it as a result of of a railroad bankruptcy, but um, I think it's a very interesting thesis because, that goes back to what are the three things you need for these data centers is water, fuel, which natural gas is going to be the bridge fuel to nuclear, but that's going to be decades. And then you need to have space. And I don't think people understand sometimes, I've traveled around quite a bit in Northern Virginia where a lot of data centers are. There's not much room to put in, a data center like Meta was talking about as large as Manhattan, where you going you start actually doing these things. Or the recent data center that's going to be put into, I believe it was Lubbock or Abilene or something, they're already running into water issues. So there's a thesis around that too, but we won't go down that road. But yeah, it's a really once you understand that business, what they're doing, and like you said, the compounding, um, it's like, well, how can I not buy be involved in this? So it's kind of interesting. Well, other like royalties. I mean, not getting specific names or anything, give away the secret sauce, but how do you think about other royalties? Because a lot of people, it's interesting. I'm always want to be like a rentier and just collect rents and, tolls and things like that. I've always been, have had a portion of my portfolio. But a lot of folks will say, well, let's look at like gold royalties or something like that, for example, royalty companies. Some of them have done very well, but everybody seems to know that the returns on capital, invested capital, and then people say, well, it's an extractive industry. All these they have a lot of negative views towards certain other royalties. Like I know, like in Horizon, they have like Cleveland Cliffs, that trust that does iron ore. What's your view on like other type royalty situations? And how do you look at them? How do you assess them? How do you value them if they're legitimate uh, ways to compound capital? Because there's a lot of folks have a different view towards them.
Yeah, I'm glad you asked because going back 18 months ago, I thought where there were all these noise about gold producers and gold juniors, and I thought you had a really potentially once in a decade opportunity in the royalty space. So again, going back a couple of years, I believe it was during COVID, I was pretty bored and doing a lot of reading. This is one of about five bookshelves that I have, the one behind me. The other ones are too big. I can't get them in the office. And I read Mike Maloney, his book, Guide to Gold and Silver. And I had this notion that, well, gold will go up in inflation and gold stocks will do even better. And then he broke it down. He did a good job, actually, in terms of saying, yeah, your top line revenue may go up, but guess what else goes up in inflation? And that is your expense column. And as simple as it was, I've never really made that connection before, I have to say. And so I was sitting there thinking, yeah, that makes a lot of sense. Fast forwarding a year or two later, discovering the power of royalty and streamers, I said to myself, well, this makes total sense. These guys are going to benefit from all the upside of the metals prices, and they're going to have basically no increased OPEX or CAPEX unless they find a deal that they want to deploy. And so I started writing a lot about the bigger names. I don't mind sharing Wheaton Precious Metals, which is obviously it's done really well since I first wrote about it. But I looked at this and I just thought it was an absolute layup when you looked at the share of production that they were going to have coming online. And I would just simply underwrite it at a $3,000 gold price, even though I think gold was at about 2,400. And going through the article, you'll see my calculations. And I said, look, this thing is, it's got 100% on the upside over the next 1 to 2 years. It's the best in class. So why are we talking about anything else, basically? So it's that same kind of principle, if I apply it generally now to getting full exposure and call optionality to price increase as well as the volume increase. That's one I think people don't understand or perhaps underappreciate. And then over time, allowing for the increase of a particular deposit to increase your volume, but you're not necessarily paying for it. And so this was the older style royalty model from Pierre Lassonde in Franco Nevada. And now, having just recently spoken with Randy Smallwood of Wheaton Precious and a lot of the smaller royalty players there, what I think you will find moving forwards is a lot of these guys start to do more streaming deals because the royalty space has since become popular and extremely competitive. And so, one of the things that stood out to me speaking with Randy was that these smaller guys, to get their foot in the door, they have to essentially enter into slightly weaker royalty contracts. So they might go into a 3 year royalty with a buyback clause. And so again, their upside is slightly capped because if they finance a deposit and it really comes to fruition, they get maybe 3 years of the royalty, and then almost always the producer's going to buy it back. Whereas longer term structured streams where you're basically agreeing to buy a share of production at a fraction of the spot price. So the spot price goes up, you're paying a quarter or a third of the spot price. The miner's getting some constant cash flows that are closer to, I suppose, a fairer economic transaction. So royalties, I think, make the most sense in terms of extractive industries that are very capital intensive, particularly in the metals markets, because you'll get access to, again, that topside revenue growth without a commensurate increase in expenses, I suppose, is the bottom line.
Yeah, I'm glad you mentioned Pierre Lassonde. I mean, he's one of the like my virtual mentors. I've read everything that he said. I think the thing that is also forgotten sometimes with royalties, maybe not so much anymore, like you said, because it's so many players now, but um he said many times that the optionality that comes along with it, because typically what happens is when you have a royalty on a property, they usually have clauses in the royalties that if additional resources are found on properties, then you have that upside too. So, he was talking in the context of Franco Nevada and saying, well, you've got 1 million or 2 million acres, hectare, whatever acres out here that are, have potential. He goes, it's just it's just a math. It just becomes a probability at some point. What is the best place to find a gold mine is right next, a gold resource is right next to another gold resource. That's pretty typical when you get into these belt systems and stuff like that without getting too far into the geology. So I think that that's another thing that's forgotten by a lot of folks. I think what turns people off sometimes is just the valuations, but they tend to be popular because they're so everybody kind of recognizes the benefit of owning them. But I think when you're in a situation like you are, I mean, that's another thing that people forget about. I think in these uh, like we're in this gold bull market now, just like you said, you start looking at companies. I listen to a lot of conference calls, and all-in sustaining costs keep creeping up too. So, if you are a mining company and you have 30%, 35% of your cost is diesel. And right now, oil prices are behaving, but there's no guarantee that 2, 3 years down the road that they couldn't go up. Energy's probably undervalued right now. And at some point they goes up, then that, your margins have a tendency then to, like you said, you know, compress. They won't be as favorable as they are now. And everything, steel, reagents, labor, everything goes up in an inflationary environment, which I think that we're biased towards going forward for at least a while now. But yeah, that's kind of interesting. Let's transition over to talking about options, and I think the first thing I'd like to start with is I'm going to make a statement, a caveat, which I think you would agree. I don't know if you'll agree. I think this is what I want to say about options. When people think about options, and we're going to be talking about options in a way that you use them that are kind of like being the house, the casino house situation. Um, a lot of people think, well, they speculate by buying puts and calls, and the research is unequivocal that about 90 to 95% of call and or option buyers lose money, or the option expires worthless. It's kind of a mug's game because with the just because of what an option is, and a lot of folks don't fully understand it. Maybe we can just give a quick synopsis on that. But um, you have to be not only right in your thesis on the price direction, but you also have to be right in your timing because the option is limited in time. And so we're not talking about that. And I recommend that nobody does that. That's the first mistake I ever made. I've told that story many times. I won't tell it again. I had an initial success when I first started speculating. And then I confused luck with genius, and of course gave it all back, which actually was a good lesson early on to learn. I'm talking like a long time ago, but anyways, let's kind of transition into that, into talking about options and how to use them properly and why they're so advantageous for creating income or and kind of juicing your returns.
Yeah, for sure. And so, again, I want to reiterate the point where I've literally separated and created new portfolios for each, which is a trick I learned from my friend Trader Ferg, that just so you don't get confused about the purpose of what you're doing in a given portfolio. Okay. It sounds a bit extreme, but I promise you it's not. On the one side, we've got long-term wealth creation. In there, the only options that would be sold would be out of the money puts to help me accumulate more shares in what I like. But I just want to get it at a better price. So if anyone's not familiar, a put option is the right for someone else to sell you a stock, which you must buy at a given price, known as the strike price, at a, over a given period of time. And the end of that contract is the expiration date. Okay, so basically, it's an insurance contract. If I'm selling the insurance on a stock, then I must basically buy that if it's at or below that strike price at any time over the contract's period. Okay. And likewise, if I was buying it, it protects my stock and I have the right to sell it at, for instance, $10, even if the stock has broken down to 6, 5, 4, 3, 2, 1. It doesn't matter. Okay. So, in terms of options, on the other hand, I have an income portfolio, and what I'm trying to do there is juice the yield on that thing, and less so now because I have lots of other sources of income. But when I originally was planning on doing the whole nomad thing for a longer period of time that I ended up doing it, it was a way that I could, if I needed to withdraw some of that cash, I could do it weekly, monthly, whatever, and I could have some left over to continue growing the portfolio. In regards to the two sides of the table, you can be the buyer of the contract. Most of the time, it's a speculation. Okay, so you think something's going to go up, like I did with Transocean call options coming out of 21, 22. And in that case, the speculation pays off massively because you've got 100x leverage. For every option you buy, if we're talking about stock options, that controls 100 units of stock, 100 shares. So you essentially have a 100x on your position. As you correctly mentioned, this doesn't last forever. Your control lasts only over the period of time which the options contract says. There are all sorts of options now. There's daily, there's weekly, there's monthly, there's over more than 1 year, etc. I always found it easier to simply do the analysis on a particular investment that I liked, form an opinion as to the value, and then start to sell options around those price points. So if I thought a company at $10 was paying a decent dividend yield of 9 or 10% per year, how could I use options to bump that up by maybe 10 or even 15%, depending on how aggressive I want it to be? And so if I'm looking at a purely income-based strategy, there's so many different techniques that I can use in terms of keeping it simple so people get a taste for it. You're looking at essentially adding to a yield of stock. So I buy a stock, I'm buying a mini piece of real estate, if you want to look at it that way, that's paying me 9 or 10% per year. In real estate, it would be rent. In stock, we're talking dividends, obviously. And then I might sell a call option further out of the money with short expiry. Okay. And by doing that over time, I can significantly add to the amount of yield, rent, or dividend, whichever way you want to look at it, in terms of what I can earn in cash payments from holding the stock.
Absolutely. This is a strategy that I use, and I actually do the same thing, segregate my accounts for my more from investing and creating wealth and then income. So I think that's an excellent point to make. Um, Obviously, if you have $1,000 Robinhood account, this probably isn't going to work for you. You need to be able to, buy
No,
buy
it's not
round
all. It's
lots.
not going
Yeah,
to work.
yeah. So we're talking a little bit more advanced strategies here for people that have bigger portfolios. But one thing let me ask you this question that I think people will struggle with because they'll go on there and they'll start looking at this. And I'm going to write this up for my subscribers more in depth about how this works. But how do you deal? I mean, I've found that I don't have to spend a lot of time on this. I track everything, obviously, because I treat it like this is a business. That's how you have to treat this. You can't
That's the
just do
key.
this flippantly on your phone. I have spreadsheets. I track. I know what the prices are. I know what the strike prices are. And you have to understand one of the things that you'll hear people poo-poo about selling calls, for example, is well, let's say I have a stock that's at 50, it's at 48, and I sell a 50 strike price that's maybe a month out. Well, what happens if the stock goes to 55? Well, it'll probably be called away at 50. And but so that doesn't happen as often as people think because the kind of stocks we're talking about, in my view at least, and correct me if I'm wrong, I try to stay around, these dividend payers that I have, they're not that volatile typically within a month or so where they're moving around like that. Um, Conversely, if you want to accumulate shares in a company, like you said, being a put writer where you can have the stock put to you, it's the same thing, but you have to be prepared to buy that stock. And of course, the brokerage firm will make sure that you have enough in your margin account. They just don't typically let people write these naked, but some do. But there'll be some controls on you. Talk about a little bit. One thing people are going to notice if they even start going looking at an option chain, the spreads that you're dealing with sometimes, and how you could say, well, you guys are talking big. Okay, well, I see it. It's 145, uh, bid or ask, or it's $3. It's a big spread, $1 and a half, $2. Sometimes you see these huge. How do you deal with that? How do you trade that? How do you make that work?
Yeah, at the end of the day, it's a market just like everything else. And so, you know what? Sometimes you might be looking at a stock that you like and you would like to juice the yield with options, but it might not be feasible for the very fact that you well mentioned there's such a spread between the bid and the ask. And in those cases, you need to make a decision. You need to make a decision, is that the right stock for that particular strategy? And you might just have to be happy with that stock and it might have a dividend yield that you like. And so, what the hell's wrong with that? That's totally fine. You may need to go further out in time. There's always a trade-off, and it's going to depend on the particular stock and its liquidity with its options chain. And that will be hugely indicative as to how close or far the spreads are. So it's just simply a matter of you doing your own personal calculations to see whether the bid and the ask or whether the bid is worth um, is worth selling in that particular case. It really is as simple as that. It might mean that you don't trade options on that particular asset. You might go closer to the money, understanding that increases the risk of assignment. You might go further out in time. So you really only got a couple of options. You can change the asset that you want to underwrite. You can not bother with options, which is perfectly fine. You can then go closer to the money, or you can go further out in terms of duration. They're what you're looking at. It all depends on the particular asset. There's no one size fits all. That's actually one of the things that I really like about it. It's completely up to you in terms of how you want to fund that strategy. You're right. You can cap your upside by selling too close to the money in terms of covered calls. But again, remember, we've separated these ideas. We're not necessarily looking for huge upside in this particular portfolio. It comes back to that function. What are you trying to achieve with this particular portfolio? Is it long-term capital gains? Is it speculation? Is it a ventures portfolio? Is it an income portfolio? And for me, what makes the most sense for options is just to generate the yield of that particular income portfolio. And look, if you can do some other really interesting strategies as well. So maybe you want to juice the yield, but you don't want to have your stock called away. You can sell an out of the money credit spread. So in other words, you can sell an out of the money call option, and you can buy insurance on that by buying a call option that's even further out of the money. You reduce the amount of or you really reduce the amount of capital at risk in terms of the calculation, and you greatly improve your yield based on that. So there are all sorts of different strategies. If people are worried about the bid and the ask spread, it's either the wrong stock, or they just simply need to go further out in duration, or they need to just wait for the volatility to pick up. It's really finding a balance that meets your particular income goals. And again, that comes back to understanding what it is you're trying to achieve with a portfolio first, and then finding strategies to fit that rather than shaping a whole portfolio around any particular type of options scenario.
What I like about your thinking, and um, and I think I've tried to emphasize this to subscribers and people on my videos when I'm talking about this. You, if you ha the whole constant theme through this whole discussion is that you have a plan. You have planned this out. You're treating this as a business. You have themes. You have ideas of what you're trying to achieve. You must have a plan. This is what I tell people. What are you trying to achieve? If you're just goofing around on your phone, you're just gambling. You're not even speculating at that point. You're just gambling, and you're not really, you're going to get what you probably deserve, which is losses and heartache and throwing your hands up. But I think that,
Or
these are
getting a margin call at 2 a.m. in the morning.
yeah, exactly. And so, I try to tell folks, I believe that, one of the things I'm kind of a big, probably Munger's my biggest guy that I just like for overall life advice plus financial advice. And, my view is, money and wealth, it's not so I can go buy a Lamborghini or fly in private, in a Gulfstream and go to the Super Bowl. It's it allows me to have more, uh, take more control of the biggest asset that each of us has, which is our time. And if you can view it, if people, I mean, you can turn this whole thing into like a snowball. I mean, you get the premiums, you do this, at least in the US, you could do this in a tax advantage account. I have a self-directed IRA, these self-directed 401ks. It's tax advantaged. This stuff, when you write the option and as soon as the trade goes through, the cash is in your account. I mean, depending on the brokerage firm and the rules, I mean, it still has to clear, but you'll see it show up. I mean, that's you start doing that, and it makes an impression on you when you start doing this, and then you say, okay, well, now I have this portfolio. Maybe one of the companies was underperforming, and now I can recycle cash back into that. That's another 100 shares here for that company. It starts becoming a flywheel or a snowball. It becomes like a growth business, and you're pursuing this. It's an intellectual pursuit that you can do, like you said, remotely from your desk on your lunch hour if you're still working, what have you. And I think, treating it like a business, having a plan, I think it's really a dynamic and very lucrative way. This is what like professional investors do. They don't go out and just, I got a hunch on from a message board, so I'm going to go out and buy an out of the money call and just watch this thing bleed out because, options lose value. Every day that goes by is good for the option writer, for us, because the value of that option is going down if the stock isn't, it's getting closer and closer to be expiring worthless. And so it's a tremendous way to manage, another way to work a portfolio, if you will. I don't know what the best term is, get additional return. And I think your article is tremendous. And I think it was, I don't want to get too far into the advanced strategies, but I think it was just kind of touching on this and like the whole philosophy of building a machine that's basically a capital machine that is, you know, just recycling capital. It just expands over time. And I think you're going to have to do that going forward. I've said this many times. I think we're entering an era, don't want to get too far off track here, where, um, you want to be an asset holder. And if you're going to be an asset holder, then you have to know how to really maximize the return on those assets, because we're going to go into some times, I think, with monetary dislocations and some of these other things that are happening. I mean, frankly speaking, the whole OECD is massively in debt, and that's going to cause a lot of problems and a lot of volatility. But we won't get too far into that. That's my view. And I think it's going to be an inflationary bias. And so if you can't stay ahead of that, then you're just going to get wrecked if you're just a wage earner that, you know, doesn't have any assets. That's crazy. So anyways, uh, that's pretty much what I wanted to talk about. I mean, I think, you know, I encourage people to go look at your Substack, Royalty King on Substack. Uh, what other products do you have? I know you have a paid subscription. I don't know how many of the articles are free. I don't remember, but I would at least get familiar. You have you do interviews. I've seen a lot of interesting folks. Why don't you expound on what your offerings are?
Yeah, sure. It's really very straightforward. The Substack, which you mentioned, the article that you're referring to is free, so that's not behind a paywall. People can take a look and they'll get a good sense for me, I suppose, and how I like to use this particular strategy. I did want to add to what you said around with all the things that are going on geopolitically. Another really important advantage to having a digital asset is that this is within the reach of most people. So most people can put together 25, 50, preferably 100K, but you can start small. And this is not dependent on any particular jurisdiction necessarily. Yes, I know your brokerage account might get flagged or something like that in an extreme case, but this is a way where people can take an asset with them if things start to go in a direction in their home country that they don't particularly like. And I think that that's an underrated point. I was at a point where I thought maybe I'll do this again. Maybe I'll roll up some other health clinics. But then with things that are happening in Australia right now, it's not particularly something that inspires a lot of confidence, if I just put it that way. And so I feel much more tranquil and at peace having a digital asset that I can run from somewhere else, if that might be necessary. But I have the Substack. It's the Royalty King, the ROI Club, and it's got a separate section for digital income, and it's got a separate section where I give you valuations on some of my key ideas. A lot of them have been multi-baggers over the years, and also the YouTube channel, which is completely free. The interviews get uploaded to Substack first. So if you're a Substack member, you get priority access, and obviously that's ad free. If you don't want to do that, totally fine. You can jump on YouTube. You can look back at some of the calls or investment analysis that I've made over the last few years, and you can decide for yourself how that's turned out with the benefit of hindsight. They're the main ones. I'm building a product which will be more of a hands-on, I guess, mastermind, particularly centered around this digital income strategies. So stay tuned for that. But I want to really have it fine-tuned and ready to go before I start spruiking it, I guess.
All right, terrific. I will have links to all this for in the show notes. I definitely appreciate you coming on. And like I said, I'm a subscriber. I find it's tremendous value. It was very helpful as I was already journeying. I mean, kind of um, some of the interviews you've done with some of the folks, bringing my thinking more to what you were alluding to earlier in the conversation. So, yeah, terrific interview, and I appreciate it. And I would like to get you back on maybe down the line and talk more. I know you're also into, the whole, I don't want to say just Doug Case, but the international man thing, because I'm kind of in a similar bent, and I know that can be. I'm very interested in that. Some of the things I've done, but kind of I know that that can be a shark-infested waters too. And if somebody, I think, if you do have wealth, you have to have that mindset. You cannot lock yourself into, wrap yourself in your national flag and have all of your assets and all of your life in one country. You're that can work out very badly, as history has shown. And I think going forward, as these governments become more and more desperate for revenue, there are different strategies that are still open to folks to hopefully diversify their life and stay away from that. Again, it's not going to work for somebody with $2,000 in a Robinhood account, but if you've been able to accumulate some decent wealth and stuff, it's definitely something
They
you
will
probably
post
should look
about it
at.
on X though, as if they had more than $2,000.
Well, yeah, I mean, there's a lot of that going on too, and that's part of what probably needs to get talked about. But anyhow, I appreciate you coming on, and good deal, and hope to have you back in the future.
Thank you. My pleasure. I can't wait.
All right, thanks.